This man is staring at something that looks exciting and dangerous at the same time. It is a financial bubble. In simple terms, that means prices have risen far beyond real value. He is watching prices shoot up on his screen. It feels thrilling because everything seems to be going higher. That is usually how a bubble first feels to ordinary investors. Now he is leaning in because the gains look easy. He feels excitement building fast. Bubbles pull people in emotionally before they trap them financially. He sees a giant arrow and starts imagining easy profits. That hope is powerful. Rising prices make people believe the trend will continue forever. He is comparing a simple house to a crazy price tag. He feels confused because the numbers no longer make sense. Price is starting to separate from value. He is measuring market price against real value. The gap is huge. That gap is the heart of what makes a bubble dangerous. He is surrounded by signals of excitement and attention. It feels like everyone is noticing the same opportunity. Social energy often pushes bubbles even higher. He is reading about a brand new opportunity. It sounds smart, modern, and full of promise. Many bubbles begin with a story that feels believable. He is looking at new technology and cheap money. These ideas can be real and important, but even good ideas can still create a bubble. He is stepping onto the path where a bubble begins. He feels curious, not panicked. At the start, almost nobody thinks they are entering a bubble. He is pointing to the word displacement. This is the first stage, when investors become excited by a new idea. Something fresh captures attention and starts pulling in money. He is watching prices begin to rise. At this point, nothing feels crazy yet. Early moves often look reasonable and harmless. He is adding one coin to the stack. Early gains make the opportunity look real. Small wins create confidence and attract more buyers. He is noticing more headlines and more attention. The idea is spreading. Interest is turning into momentum. He is standing beside the boom stage. Prices are now rising with more speed. The crowd starts joining because it looks like easy money. He is seeing more people enter the market. That makes him feel like he should join too. Herd behavior becomes stronger as prices rise. He is watching the media talk about rising prices again. That attention makes the trend feel safe and important. Hype often helps fuel the boom. He is looking at easy credit and cheap borrowing. Money is easy to access. That gives investors more fuel to chase higher prices. He is signing a loan paper to invest more. He feels nervous, but greed pushes him forward. Borrowed money makes the whole system riskier. He is climbing higher to reach even more gains. The move looks ambitious, but unstable. People stretch farther when they think prices cannot fall. He is now in the euphoria stage. Prices are soaring and caution is fading. This is the phase where bubbles become truly dangerous. He is pushing away the calculator and valuation book. He no longer wants boring facts. Logic often gets ignored during euphoria. He is saying this time is different. He feels confident that old rules do not apply. That belief appears again and again in bubble history. He is watching prices go almost straight up. It feels unbelievable and exciting. Extreme moves can make people emotionally blind. He is checking social media and seeing other people celebrate. That makes him feel left behind. FOMO grows strongest near the top. He is rushing in with cash. He does not want to miss the next move higher. Speculation is now driving the decision, not value. He is standing proudly on unstable gains. He feels rich, but the base is weak. Bubbles often look strongest just before they break. He is seeing ridiculous prices and still smiling. That is what happens when excitement replaces analysis. Valuations become extreme and people stop caring. He is surrounded by greed, herd behavior, and FOMO. Those forces are emotional, not rational. Bubble psychology is often stronger than logic. He is staring at an enormous bubble now. It looks beautiful, but unsafe. The bigger it grows, the more fragile it becomes. He is entering the profit-taking stage. Smart investors begin to act differently here. They stop asking how high it can go and start asking how much they could lose. He is selling quietly while others still celebrate. He feels cautious, not euphoric. Experienced investors often leave before the crowd notices the danger. He is noticing that the bubble is starting to wobble. The trend no longer feels smooth. Small cracks often appear before a major collapse. He is stepping away from the crowd with his gains. He does not know the exact top, but he sees the risk. Good investing is often about survival, not perfection. He is studying a chart that has stopped climbing. Momentum is fading. Market tops often form quietly while the crowd still feels confident. He is seeing the first serious red candle. That small change matters. Warning signs usually appear before panic becomes obvious. He is closing a position while others still feel invincible. He looks calm, not dramatic. Smart money often exits slowly and quietly. He is standing beside the message that smart money leaves early. That does not mean perfect timing. It means respecting risk before everyone else does. He is looking closely at a crack in the bubble. Small cracks can become big fast. Once confidence weakens, the entire structure can fail. He is now in the panic stage. The bubble is collapsing fast. Fear replaces greed almost overnight. He is dropping his papers as prices plunge. Shock replaces confidence. The same market that felt easy now feels terrifying. He is trying to sell on his phone as everyone rushes for the exit. He feels desperate. Panic makes people act fast and think poorly. He is surrounded by falling red arrows. The gains are disappearing quickly. Crashes often feel much faster than booms. He is reading that everyone wants out at once. That creates a dangerous imbalance. When too many people sell together, prices can collapse hard. He is pointing to supply overwhelming demand. Too many sellers are chasing too few buyers. That is how panic turns into a crash. He is watching prices fall like dominoes. One drop triggers the next. Fear feeds on itself in a bursting bubble. He is looking at a broken piggy bank and falling home prices. Losses now feel personal. The emotional pain becomes real very quickly. He is standing beside the words bubble burst. The dream has broken apart. What looked unstoppable is now collapsing in front of him. He is sitting down after the crash and reading his losses. He feels tired and reflective. That is often when people finally admit it was a bubble. He is pointing to the aftermath of the bubble. Crashes can hurt jobs, credit, and the wider economy. The damage often spreads far beyond investors. He is reviewing the full 5-stage cycle. The pattern is easier to understand after it happens. Looking back always feels clearer than living through it. He is standing next to a tulip with an absurd price. It seems silly now, but it was serious then. Tulip Mania remains one of the most famous bubble stories. He is holding the tulip bulb like treasure. People once treated rare bulbs like luxury assets. Speculation can make almost anything look priceless. He is watching the tulip price collapse. What looked valuable suddenly becomes hard to sell. Confidence can disappear faster than it was built. He is explaining Tulip Mania as one of history's famous bubbles. The story is old, but the psychology is familiar. Human behavior has not changed much. He is looking at a South Sea stock certificate. Investors were promised huge opportunities and riches. Big promises have always been part of bubble history. He is watching the stock price shoot higher. The promise of easy wealth pulls people in. Stories can inflate expectations far beyond reality. He is watching that same stock collapse. Optimism turns into regret. Hype is never the same thing as value. He is pointing to the 1929 market and margin debt. Borrowed money made the boom more fragile. Leverage often turns a bubble into a disaster. He is reading about the crash in shock. Confidence broke and panic followed. Market bubbles can spill into the real economy in painful ways. He is looking at Japan's stocks and real estate rising together.
Everything seemed to be getting more valuable at once. That kind of broad boom can feel unstoppable. He's explaining how extreme those prices became. Land and stocks both looked unstoppable. A bubble can spread across multiple assets at the same time. He is watching both assets fall together. The damage lasted for years. Some bubbles do not just burst, they leave a long economic hangover. He is sitting at an old internet computer with excitement. The web felt revolutionary, and in many ways it was. Real innovation can still attract unrealistic valuations. He is watching tech stocks rise rapidly. Investors believed the future had arrived. That belief fueled the dot-com bubble. He is confused because companies with little profit have huge valuations. That mismatch is a warning sign. Narratives can outrun fundamentals for a while, but not forever. He is stunned as dot-com prices crash. Easy money disappears and weak companies collapse. When belief fades, prices can fall brutally. He is summarizing the dot-com bubble clearly. It was built on excitement, speculation, and unrealistic pricing. It became a classic lesson in market excess. He is looking at cheap mortgages and low rates. Buying homes suddenly feels easy. That is how the housing bubble found new fuel. He is signing mortgage papers with confidence. Easy lending makes risk feel invisible. Credit can make bubbles grow larger and faster. He is watching home prices rise fast. It starts to feel like housing can only go up. That belief is common near the peak of a bubble. He is flipping a house icon like a quick trade. The focus is now profit, not living value. Speculation has fully entered the housing market. He is reacting as prices fall and bills pile up. Debt makes the pain much worse. Leveraged bubbles can create deep economic damage. He is explaining the 2008 housing crash. When the bubble burst, the damage spread across the global economy. It became one of the clearest modern examples of bubble risk. He is showing that bubbles are not limited to one market. They can appear in stocks, housing, commodities, bonds, or crypto. The pattern repeats across many assets. He is studying a chart that rises almost straight up. That kind of move can be a danger sign. Vertical price action often deserves extra caution. He's looking at unusually high trading volume. Big volume can mean growing speculation. When everyone rushes in together, risk may be building. He is watching everyone rush in together. Crowd behavior can push prices beyond reason. Herd psychology is one of the strongest bubble signals. He is struggling to hold the weight of leverage. Debt can magnify gains, but also losses. The more borrowed money involved, the worse the crash can become. He is asking whether story has replaced fundamentals. A compelling narrative can hide serious risk. Investors need to ask what is real and what is only excitement. He is comparing strong prices to weak fundamentals. When those two move apart, caution matters. Markets can stay irrational, but reality usually catches up. He is seeing party-like media attention around the asset. Public frenzy often means speculation is widespread. When everybody is celebrating, it may be time to get careful. He is reminding us that bubbles are hard to identify in real time. Most people only see them clearly after they burst. That is why humility matters in investing. He is inspecting price and value more closely. Thoughtful analysis can reduce emotional mistakes. Slowing down is often a powerful advantage. He is stepping back instead of chasing the glowing bubble. Discipline can feel boring, but it protects capital. Not every rising asset deserves your money. He is checking risk, debt, value, and narrative. Good investing asks hard questions before joining the crowd. A checklist can be stronger than emotion. He is balancing opportunity with caution. Good investors do not ignore excitement, but they respect risk. The goal is not fear, but clarity. He is pointing to the whole cycle one last time. Displacement leads to boom, then euphoria, profit-taking, and panic. Knowing the pattern can help you stay grounded. He is writing that prices can rise fast, but reality still matters. That is the heart of the lesson. Bubbles grow on hope, but collapse on truth. He is facing the audience calmly after the full story. He now understands that bubbles are emotional, repetitive, and dangerous.
The best defense is to stay curious, skeptical, and disciplined.
Financial bubbles look exciting while they grow, but dangerous when they burst. The biggest lesson is simple. When prices rise faster than reality, risk is rising too. If this video helped you understand bubbles better, like, subscribe, and comment which bubble in history shocked you the most.